I need you to understand something that happened in the last 24 hours, that the mainstream financial press has not yet connected to the precious metals market with the precision it deserves. Because what China just did, the specific policy decision that Beijing announced, is not a trade restriction. It is not a tariff adjustment. It is not a diplomatic signal designed to create negotiating leverage at a summit. It is a permanent structural intervention in the global silver supply chain that changes the fundamental supply-demand equation of this market in a way that cannot be reversed by any future negotiation, any future summit, or any future policy reversal on the Western side. China has banned silver exports permanently. Let me say that again because I want it to land with the weight it deserves. The country that is simultaneously the world's largest silver producer, the world's largest silver consumer for industrial purposes, and the world's largest manufacturer of the solar panels, semiconductors, and electronics that require silver as a non-substitutable input, that country has made a permanent structural decision to stop allowing silver to leave its borders for export. This is not a temporary measure. This is not a negotiating chip. This is Beijing making a strategic calculation that silver, the metal embedded in every solar panel junction, every advanced semiconductor package, every AI data center power system, is too strategically important to allow to flow freely into the Western supply chain that has historically relied on Chinese production to balance global supply and demand. And that calculation, once made and implemented, changes the global silver supply map in a way that has no modern precedent. Today, I need to walk you through exactly what this means. Not in vague narrative terms, in precise, quantifiable supply-demand terms. Because the investors who understand the specific mechanism by which a Chinese silver export ban transmits into Western market prices, and the timeline on which that transmission happens, are the investors who are going to be positioned for what comes next. And what comes next, based on the supply-demand arithmetic alone, is a repricing of silver that makes every analyst target you have heard discussed on this channel over the past 2 weeks look conservative. Asian guy here. Let me show you the engine. Because this time the price is not just the exhaust. This time the engine itself just changed permanently. Let me start with the precise data, because you cannot evaluate the impact of a Chinese silver export ban without first understanding exactly how much of the global silver supply chain runs through China. And the numbers, when you see them laid out clearly, explain immediately why this policy decision is categorically different from any previous Chinese commodity export restriction. China is the world's third largest silver producing nation, accounting for approximately 13% to 14% of global mined silver production annually. That is roughly 110 to 120 million ounces per year from Chinese mines alone. In a global market that produces approximately 820 to 850 million ounces per year from all sources, Chinese mine production represents a significant but not dominant share of primary supply. But mine production is only part of the story, and it is the smaller part. China is also the world's largest processor of silver-bearing materials. The country that takes silver-rich ore concentrates from mines in Mexico, Peru, Bolivia, and other major producing nations, runs them through its enormous refinery complex, and exports refined silver back into the global market. Chinese refineries process a disproportionate share of the world's silver ore concentrates, because China built the world's most efficient, most cost-effective precious metals refinery infrastructure over the past 2 decades. The economics of global silver processing have been structured around Chinese refinery capacity for years, which means that when China bans silver exports, it is not just removing its own mine production from the global float. It is removing the refined output of a refinery complex that processes ore from mines all over the world. Add to that the silver recovered as a byproduct of China's enormous base metals smelting industry. China is the world's largest producer of zinc, lead, and copper, the 3 metals from which the majority of the world's silver is recovered as a byproduct. When Chinese zinc smelters process zinc concentrate, silver comes out the other end. When Chinese lead smelters run, silver is recovered. That byproduct silver, the silver that is produced as a consequence of China's dominance in base metals production, has historically been a significant source of global silver supply. And under a permanent export ban, that silver stays in China. Now add the recycling and secondary recovery dimension. China has the world's largest solar panel recycling infrastructure, processing end-of-life panels and recovering the silver paste used in their production. As the first generation of utility-scale solar installations begins reaching end of life, which is happening now, given that the panels installed during the early 2010s solar build-out are approaching their 15 to 20-year operational lifespan, the silver recovered from recycling flows through Chinese facilities. Under an export ban, that silver stays in China too. When you add primary mine production, refined or processing, base metals byproduct recovery, and secondary recycling together, and apply an export ban to all of it, you are looking at a potential removal of 200 to 250 million ounces per year from the global silver float, in a market that was already running a structural supply deficit before this ban was announced, in a market where the Silver Institute projected a sixth consecutive annual supply deficit in 2026, in a market where the Western supply chain, the COMEX, the London OTC market, the industrial users in North America and Europe that manufacture solar panels, semiconductors, and electronics, has been dependent on Chinese supply flows to balance its own supply-demand equation. That dependence is now broken, permanently. And the Western silver market has to find 200 to 250 million ounces per year from somewhere else, somewhere that does not exist at current production levels. Now let me walk you through the supply side of the equation that the Chinese export ban has just fundamentally altered. Because the question every investor needs to answer right now is not just how big the supply gap is, it is how fast the gap can close. And the answer to that question, informed by the mechanics of how silver mines are developed and how refinery infrastructure is built, is the most important input for understanding the price impact timeline. The primary silver producing nations outside of China are Mexico, Peru, Chile, Bolivia, Russia, Poland, and Australia. Mexico is the world's largest silver producer, accounting for approximately 23% of global mine output. Peru is second at approximately 15%. Together with the other major producers, the non-Chinese primary silver production base can theoretically replace some of the supply that the export ban removes. But here is the critical constraint. You cannot simply turn up the output dial on an existing silver mine. Mine production is determined by the ore grade of the deposit being worked, the processing capacity of the mill, and the physical constraints of moving ore from underground or open pit workings to surface facilities. Expanding mine production by 20% or 30% requires capital investment in equipment, additional workforce, and in many cases, new development of previously unworked sections of the ore body. That process takes years, and opening entirely new mines, the new primary silver deposits that would need to be developed to permanently replace Chinese supply, takes the 7 to 10 year timeline I have discussed in previous videos. Environmental permitting alone takes 2 to 4 years in most major producing jurisdictions. Mine construction takes another 2 to 3 years. Ramp up to full production takes another 1 to 2 years. The earliest that a new mine responding to today's Chinese export ban can deliver its first ounce of silver is 2033 at the absolute minimum. And realistically, given the permitting environment in Mexico, Peru, and the other major producing nations, new mine supply in response to the Chinese ban will not be meaningfully contributing to global production until 2034 or 2035. What about refinery capacity? The silver refinery infrastructure outside of China, in Switzerland, Canada, the United States, and Australia, has capacity that is significant but not sufficient to absorb the full processing role that Chinese refineries have been playing for global ore concentrates. Building new refinery capacity is faster than building new mines, 2 to 3 years rather than 7 to 10, but it still cannot close the gap in the near term. And the capital to build new Western refinery capacity has to be justified by a price signal strong enough to make the investment economics work. That price signal has not yet been fully transmitted to the market. In the near term, the next 12 to 24 months, the Western silver supply chain has no clean solution to the gap created by the Chinese export ban. The metal that was flowing from Chinese mines, Chinese refineries, Chinese base metals, byproduct recovery, and Chinese solar panel recycling into the global float, that metal is gone. The industrial users in North America, Europe, and Japan that have been sourcing silver from supply chains that included Chinese production need to find alternative sources. And the alternatives, non-Chinese mine production, non-Chinese refinery output, cannot expand fast enough to meet that demand at current price levels. The price has to move, not to bring existing supply to market. Existing supply is already fully committed. The price has to move far enough to change the demand picture, to make some industrial applications of silver uneconomic at current consumption rates, to incentivize the development of new supply sources on the 7 to 10 year timeline, to clear a market where the structural supply deficit was already running before the export ban removed 200 to 250 million ounces per year from the global float. How far does the price have to move to accomplish that? History gives you the answer. When a commodity market faces a sudden, structural, non-reversible supply reduction of this magnitude, when the supply side of the equation changes permanently rather than cyclically, the price moves to a level that creates either significant demand destruction or significant supply response from marginal producers who were previously uneconomic. In silver's case, given the non-substitutable nature of its industrial applications, you cannot make a solar cell without silver paste at current technology levels. Demand destruction requires very high price levels before significant consumption reduction occurs. which means the price signal has to be extreme enough to incentivize new mine development and new refinery construction. And extreme price signals in commodity markets do not arrive gradually. They arrive in sudden, sharp repricing events. Now, let me explain why the timing of this Chinese export ban, arriving in May 2026 at this specific moment in the silver demand cycle, is the most catastrophic possible timing for the Western silver supply chain. Global solar deployment is at an all-time high and accelerating. The International Energy Agency has projected that solar capacity additions will continue growing at double-digit annual rates through 2030. Every megawatt of solar capacity requires silver paste at every cell junction of every panel. The silver demand from solar manufacturing alone, which the Silver Institute documented at 29% of total industrial silver demand in 2024, up from 11% in 2014, was already creating structural pressure on silver supply before China's export ban removed a quarter of the global float. Simultaneously, AI infrastructure capex is running at $715 billion per year from just 4 hyperscalers: Meta, Alphabet, Microsoft, and Amazon. That capital is being deployed into data centers that require silver in their semiconductor manufacturing, their PCB production, and the solar power installations being built to supply their enormous electricity demand. The AI demand wave for silver was already a new, unprecedented, not yet fully priced demand driver before the export ban. After the export ban, that demand is competing for a significantly smaller global silver supply. And the EV transition continues. Every electric vehicle contains between 25 and 50 grams of silver in its electrical systems, battery management technology, and charging infrastructure. Global EV sales have been growing at 30% to 40% annually. The silver demand from EV production alone added tens of millions of ounces per year to global consumption over the past 5 years. And that trend has not slowed. All 3 of these demand drivers, solar, AI, EVs, are growing simultaneously. All 3 are non-discretionary, in the sense that the manufacturers consuming silver cannot easily reduce their consumption without either slowing production or finding a technological substitute that does not currently exist at scale. And all 3 are now competing for a global silver supply that is 200 to 250 million ounces per year, smaller than it was before Beijing's announcement. This is the collision, the most powerful convergence of industrial demand drivers in silver's history, meeting the most significant supply reduction in silver's modern history. In the same month, in the same market. In a market that was already running a 6th consecutive annual supply deficit before either of these forces was as large as they are today. The supply-demand math in this new reality does not produce a modest price increase. It produces a repricing event, a structural, sustained repricing that has to go high enough and stay high enough to either incentivize new supply on a 7 to 10 year timeline or reduce demand in sectors that are structurally resistant to demand reduction. Let me walk you through what happens next in the Western silver market, because the institutional response to a permanent Chinese export ban is not passive. The COMEX, the London OTC market, the industrial users, and the governments of major consuming nations will all respond. And understanding the limits of those responses is the key to understanding why the price impact of this ban is not a 1-week spike, but a multi-year structural repricing. The first response will be inventory drawdown. The major silver consumers in North America and Europe, the solar manufacturers, the semiconductor fabs, the electronics companies, maintain strategic inventory of silver to buffer against short-term supply disruptions. Those inventories will be drawn down as companies wait for alternative supply chains to be established. The drawdown of industrial silver inventories provides a temporary cushion, measured in weeks to months, depending on the size of the inventory buffer, during which the price impact is partially absorbed rather than immediately transmitted to production costs. But inventory drawdown is not a solution. It is a delay. When the inventories are drawn down and the alternative supply chains have not yet been established, which, given the 7 to 10 year mine development timeline, they cannot be, the industrial users face a genuine supply crisis. They cannot make solar panels without silver paste. They cannot manufacture advanced semiconductors without silver-based die attach and thermal interface materials. The choice becomes, pay whatever price the market requires to secure silver from non-Chinese sources or slow production. And for companies with contractual delivery obligations to their own customers, solar project developers, data center operators, EV manufacturers, slowing production is not an option. They pay the price. The second response will be government intervention. The United States, the European Union, and Japan, the major Western economies whose industrial bases are most dependent on silver, will explore strategic reserve releases, emergency trade negotiations, and incentive programs for domestic silver production. But strategic silver reserves in the West are limited. The U.S. government sold most of its silver strategic reserve decades ago. emergency trade negotiations with alternative producing nations, Mexico, Peru, Chile, take months to years to translate into additional physical supply. And incentive programs for domestic production face the same 7 to 10 year mine development constraint that the private sector faces. The third response will be price-driven substitution research. At high enough silver prices, some industrial applications will develop silver reduction or silver substitution technologies. Solar cell manufacturers have been working on reducing silver paste consumption per cell for years, driven by exactly the kind of price incentive that this ban creates. But technology development takes time. The substitution technologies that reduce silver consumption in solar cells are measured in years of R&D, not months. And in the interim, in the years between the export ban removing supply and the substitution technologies reducing demand, the market clears at a higher price. Each of these responses, inventory drawdown, government intervention, and substitution research, operates on a timeline measured in years, not weeks. The gap between the supply reduction happening now and the responses that can address it is measured in years. And the silver price in those years is determined by the willingness of the marginal buyer to pay whatever is necessary to secure physical supply in a market where the supply is genuinely, structurally insufficient. Let me close with the price implication because after everything I have just walked you through, the supply gap, the demand acceleration, the response limitations, the timeline constraints, the question every investor is asking is the same one. What does this mean for the price of silver? I am going to answer that question with arithmetic rather than opinion. Because in a market where a structural supply change of this magnitude has occurred, the price implications are not a matter of optimism or pessimism. They are a matter of supply and demand clearing at a new equilibrium that reflects the permanent removal of a major supply source. Before the Chinese export ban, the Silver Institute was projecting a sixth consecutive annual supply deficit in 2026 of approximately 150 to 200 million ounces. The export ban removes an additional 200 to 250 million ounces from the global float annually. The combined deficit, the pre-existing structural deficit plus the export ban removal, is now running at 350 to 450 million ounces per year, in a market that produces 820 to 850 million ounces per year from all remaining sources. That is a deficit of 40% to 55% of remaining production. Not a tight market, not a supply-demand imbalance, a crisis. Commodity markets that face supply deficits of 40% to 55% of production do not adjust gradually. They reprice sharply and rapidly to the level at which demand destruction or emergency supply response restores balance. For silver, given the non-substitutable nature of its major industrial applications, the demand destruction price, the level at which meaningful reduction in solar, semiconductor, and EV silver consumption occurs, is significantly above current levels. Analyst estimates for this threshold vary, but most industrial commodity analysts put demand destruction for silver in solar applications at prices above $150 per ounce, where alternative cell architectures with lower silver content become economically justified for new installations. Between $85, where silver is trading today, and $150, where demand destruction begins to meaningfully reduce consumption in the largest demand category, the market has to find a clearing price that either brings forward emergency supply from non-Chinese sources through extreme price incentivization or reduces consumption in applications where silver can be partially substituted or reduced. That clearing price discovery process, the repricing of a commodity facing a 40% to 55% production deficit, does not happen in a week, but it happens. And when it happens in a market this structurally imbalanced, it happens with a velocity and a magnitude that makes every analyst price target currently on the table look like an underestimate. Bank of America's $86 target for 2026, the $309 bull case, the $200 projections from the veterans who have been in this market for 40 years. All of those targets were built on a supply-demand model that did not include a permanent Chinese export ban, removing 200 to 250 million ounces per year from the global float. They need to be rebuilt from the ground up with the new supply reality embedded in every line of the model. And when those models are rebuilt, when the analyst community finishes processing what Beijing just announced and updates their supply-demand frameworks with the post-ban numbers, the price targets that emerge will be numbers that the mainstream financial press will describe as extreme, and that anyone who has been following this channel understands as the natural arithmetic conclusion of a permanently changed supply map. The global silver supply map has changed forever. The investors who understand that today, who have walked through the supply gap, the demand acceleration, the response limitations, and the price arithmetic, are the investors who are positioned for the repricing that the new supply map implies. Not the $86 target, not the $150 demand destruction threshold. The price discovery process that begins when the market fully absorbs what China just did and recognizes that the silver supply chain the Western industrial economy was built on no longer exists in the form it existed yesterday. This is Asian Guy. If this breakdown gave you the complete framework for understanding what a permanent Chinese silver export ban means, the supply numbers, the demand collision, the response limitations, the price arithmetic, like this video and share it with every silver investor you know, because the map changed today. And every investor who is still reading the old map is going to be navigating with information that is no longer accurate. The supply is gone. The demand is accelerating. The price has to find a new equilibrium, and that equilibrium is not $85.